Good morning, traders. Today is December 24th, Christmas Eve. Merry Christmas to all of you. And as we move into the new year, I want to alert you that there's going to be some big changes on my website, MENT.com. Everything is going to get more improved and better structured for all of you to be able to take advantage of the services and the tools that I provide, as well as the custom research and analysis related to the U.S. stock market, global markets, and real estate and others. So we're going to be expanding out services and providing better solutions for all of you. Now, this video is focused on the MENT Rotational Modeling System and the real estate market. I break my videos into three separate sections. First, the custom indexes. Second, the TT scanner, which are swing trading, weekly swing trading setups for traders that want to take advantage of general market swing trades, which can be very powerful. Have been fairly flat the last couple of months because the market's been in a consolidation period. And this video, which is the MENT Rotational Modeling System results and the updated weekly U.S. real estate market conditions. So nothing much has changed with the rotational modeling system. You can see here we're still on a weekly basis. It's all based on the SPY. And what we are basically doing is using this to help you manage and protect your equity in your retirement account. And this is basically a longer term strategy. So think of this as the high level master strategy that we use to pick and determine how we are going to try to take advantage of market trends from a very long-term, high-level scenario. And I'll show you the real benefit to this as we move forward. Now, generally, it's broken into two accounts. So the way I run my account is I have two separate accounts, and one runs the daily system, which is 75% of the equity, and the other runs the weekly system, which is 25% of the equity. The weekly system is still bullish on the SPY, has been bullish since 6/10/2020. I need you to understand that this means that throughout this entire correction of 2022, we have not seen the weekly system turn bearish. It has stayed bullish. We've allocated 25% of our capital, and we've got a 19.91% profit in that trade as of Friday. The daily system went bearish on 8/31/22. Now it's gone up and down across the board here, but we are 75% of our equity is bearish. We've got a 4.62% profit in that trade. Now, obviously, many of you might be questioning, well, how can you be bullish and bearish? It nets into a net 50% short position in one account and 50% cash. When we're long 25% and short 75%, the 25% offsets 25% here, netting us 50% cash and 50% bearish. That's what this single account portfolio looks like. So we're basically in a single account. You would be 50% cash, 50% bearish. The bearish trigger was 8/31/22. You still got your 4.26% profit. And essentially, when we're long and short like this, one side is offsetting the other. For every dollar we gain here, we lose a dollar here. For every dollar we gain here, we lose a dollar here. And this is how the system works. Okay, it's designed to keep you safely protected from risks related to the general market. Now, our current position sizing is at 20% stocks, meaning we have a 20% allocation for you to trade individual stocks, make discretionary trades. We're 55% cash, 25% metals, and 0% bonds. This is our primary allocation table. And this is something that I determine based on what I'm seeing in the market and how the system is performing, as well as looking at these primary markets. So understand, we're looking at the SPY, the transportation index, which leads the market typically during a recovery or contraction period. The mid-cap S&P mid-cap 400, the ES, the S&P E-mini futures, S&P 500. The NASDAQ, the Dow Jones, gold, silver, crude oil, bonds, and consumer staples. Currently, we are seeing a again daily bearish on the SPY, weekly bullish. Transportation is both daily, weekly bearish. Mid cap is both daily, weekly bullish. S&P 500 ES is weekly bearish, daily bearish, weekly bullish. Nasdaq is daily bearish, weekly bearish. Dow Jones is daily bullish, weekly bullish. Gold is daily bullish, weekly bearish, about ready to change in my opinion, just got to get a little higher. Silver is daily bullish, weekly bearish, about ready to change. We're nearing a very a strong breakout period in silver. Crude oil is daily bearish, weekly bearish. Bonds are daily bearish, weekly bearish, that's TLT. And consumer staples is daily bullish, weekly bullish. So what's happening here is we're getting a little bit of a consolidation and an upward trend in not only the consumer staples, the Dow Jones and the mid caps. We're getting some strength in the gold and silver, which is elevating some fear levels. Like to see these move into bullish territory. Crude oil is weakening. I believe crude oil will likely continue to try to move down and settle down in the $64, $65 area. I'll show you that here in a minute. Bonds are struggling. They are still forming a bit of a bottom, but we haven't seen any real confirmation of an uptrend yet. What we're really looking for is, at this point, the transition away from the 2022 correction, hopefully, and moving into a what I'm calling a reflation trade in 2023. I believe the Fed is going to become a little bit more adaptive to what's going on in the global markets. I believe there's been plenty of money printed. The U.S. just signed a $1.7 trillion spending bill. So understand that inflation concerns, and as long as consumers stay relatively healthy and there's no massive financial crisis event or major crisis event throughout the world, then I believe we're going to move into a reflation trade in 2023 and 2024, which will basically be very similar to what happened in 2002, 3, 4, 5, 6, kind of a reflation trade after the dot-com and the 9/11 terrorist attacks. Remember, the markets had bottomed. We had kind of had a devaluation period for about 2 years. And then we moved into a moderate reflation trade. And I think that's kind of what we're going to see over the next 3 or 4 years, is a moderate upside reflation trade. We don't have any confirmation of an uptrend yet, so we're staying relatively cautious, which is why our allocation levels are where they're at. You can see as an alternate allocation level, if you're not able to move into metals efficiently in your retirement account, you'd want to be 20% into stocks, 80% into cash, and 0% into bonds. The idea here, ladies and gentlemen, is we've been this way for months, many, many months. In fact, almost all of 2022, we've been in this type of scenario. And the purpose behind this is that we're pulling capital away from risk. We're moving capital safely into cash, using metals as a hedge, and then we will redeploy our capital when opportunity strikes. So again, if you had followed the system, and let me show you, if you had followed the MENT Rotational Modeling system, you would have been looking at this type of a return versus this type of return just doing nothing. And had you followed the MENT Rotational Modeling system since 1996, you would have seen this type of an equity growth versus this type of equity growth in the SPY. And you can see here that the reality is the system continues to perform. And it's very interesting to see how the system, the MENT Rotational Modeling system, performs much better in sideways downward markets versus the SPY. You can see here, this was the 2000 collapse. This was the reflation trade. This is the 2008, 9, 10 collapse. This is the reflation trade all the way up. These are the corrective periods of COVID in 2018. And now we have the current correction period in 2022. You can see here that as the S&P collapsed, in both of these instances, the MENT Rotational Modeling system continued to perform. And that's the benefit of the actual MENT Rotational Modeling system, is it gives you the ability to protect and grow your capital when most other people would be dealing with a minus 20, 30, 40, 50% downturn. And you can see over here, we went from roughly 400,000 prior to the 2008 collapse. By the time the markets had recovered back over here, we were close to 570,000, almost 600,000 during this time frame when the markets were rolling around in 2015, 16, and all the way up to 17, 18, 19, just before COVID. We went from about 570,000 to about a million. So imagine that the S&P rallied from about 220,000 roughly up to about 450,000, about a $200,000 gain, whereas the MENT rotational modeling system, by deploying capital more efficiently, rallied almost $550,000 over that same time frame. Quite an impressive move, more than double. And that's what's very interesting about this, ladies and gentlemen, is the MENT rotational modeling system outperforms the S&P by close to 280% on average, going back over about 24 years. So as we continue to move forward, what we're looking at right now is the MENT rotational modeling system is currently in this net bearish position. 50% bearish, 50% cash. We have a little bit of profit in the trade. We're likely going to close out the end of the year. I want to show you this. It's going to be very interesting to see how the end of the year plays out. Once I get to the end of this year, which is about a week away, I'll update this data. This was updated as of 2 weeks ago. We may actually turn positive this year. It'll be very interesting to see if we turn positive 2022. It may not be a big number, but while everybody else is going to be looking at possibly minus 30, 40, 50% losses in their account, we might actually turn a small little positive with the MENT rotational modeling system and get ready for another year. Now understand that if my analysis is correct, we are going to be looking at something like 2003, 4, 5, 6 time frame where we're going to see the markets melt upward after the collapse here 2000 and 2001. So we may be looking at these similar types of gains, maybe a bit more, maybe 8, 9, 10, 11% over the next 2 or 3 years going forward, if my analysis is correct. So hold on, guys, and follow me. This is going to be very important. As the markets transition, this is where you're going to see huge opportunity for growth moving forward. By taking advantage of and smartly deploying your capital into efficient markets. Okay, now we go to the real estate market. The real estate market, last week, Realtor.com had a blip in their data. They said they updated the data, but they really didn't update the data. So now I want you to be aware that we just had the Fed raise interest rates by 50 basis points. This data has not translated into the market data yet. It'll be that way over the next 3, 4, 5 weeks. We'll start to see what's going on. But I want you to be aware that reductions are now, this is the yellow line right here, have been above 100%. We are seeing pretty much everything being reduced on the market right now. Prices are coming down because affordability is unattainable for many people. You're seeing active listing counts skyrocket, the highest active listing count now close to 60%. So understand that we've gone from negative active listing counts to positive, and they continue to move higher. Pricing is starting to collapse. That's this dark blue line right over here, starting to collapse fairly aggressively. I expect that by March, April of next year, we're going to be in negative pricing territory, maybe a bit sooner. We'll see how it plays out and see what happens over the first couple of months in 2023. Price reduction share has moved into positive territory from being in negative territory back over here. And of course, median days on market are hovering down in this area here. And what's happening in this area is, as you're starting to see inventory kick in, you're going to start to see houses get pulled off the market and then put back on the market a week or two later. And this is a tactic that's used to keep days on market fairly mild. We've seen it increase considerably. Understand, days on market, this gray line was way down in this area in June 2021, has moved all the way back into positive and has moved kind of a flat line area. I believe in reality, what you're seeing is property is being moved off the market and put back on the market in different prices as people try to restructure and manage the listing and the data that we're looking at. So be aware that this is going to change as inventory continues to flood. As this active listing count continues to skyrocket, you're going to see days on market start to move higher, and it's probably going to move back up into the 14, 15, 20, maybe 25, whereas right now it's like 8, 9, 10, 11. So be aware that it's moved from negative days on market to positive, and we're just in this transition period. With the Fed pushing rates a bit higher, we're going to start to see the bottom weaken out of the market and move downward. My dynamic price trend modeling system is a move back from positive side over here in early 2022. Now understand that we have the model market demand in orange and the pricing factor in blue. Pricing factor was very positive at the end of last year and beginning of 2022. Same thing with market demand. Everybody was trying to get into what they could at the cheapest rates before the Fed continued to raise rates. Now with the Fed moving higher, we've seen it kind of flatline back down to the weakest pricing level and market demand level really combined over the last 2 years. This is the weakest we have been. Real pricing factor is at negative 46.61, down 0.52% last week. And model market demand is at negative 38.95, slightly up 0.39% last week. What that means is that we're seeing a little bit of reprieve in market demand, but we're seeing pricing factor is dramatically lower. And as long as pricing continues to weaken, demand will weaken. What happens is it's a very psychological game. But as price starts to decline, as market trends really weaken, certain consumers will not be chasing a downward price factor unless they absolutely have to, or unless there's real opportunity to get into something. They will be looking at waiting for the market to play out its trend, waiting for a potential bottom, and then we will see investors start moving in as prices look to become more affordable. Okay, now we go to the next page, which is the real estate price trends. These have all been updated as of Thursday. Price trends again are weakening. We saw them recover in June, July, August. This was a deeper weakening area. So this was really kind of a change, the first real deeper change in the market since June. April, May, June of 2021. We're in a downward cycle again. I do expect this to move downward. You can see here, April, May, June, we start to see a decline. April, May, June. Now, granted, this was COVID. We see a decline. You can see here, April, May, June, we start to see some moderate weakness. This was during a really strong price advance area. But I believe as we start moving into the beginning of next year, we're going to see this move back lower, maybe get down into this minus 10, 15, 20% area. So as we move into real estate price trend or price reduction activity, you can see that price reduction counts have moved up above 100% again, and the trend has moved upward. This is reduction share of market and price reduction activity. So this is share of market. It's now almost 105%. Everything's being reduced. Real estate active listing change. Active listings have flooded back into the market after stalling. This is really the event of homeowners reaching kind of their limit with regards to inflation trends and trying to get out of the market near these peaks. You can see new active count metrics. We have new counts, new listing counts at the newest, highest level. We have new count changes moving back to positive in the area here. So you can see new count changes at plus 0.41. New listing counts at 58%, which means that we're seeing huge numbers of new listings come in. And new share of market, which is relatively weak. is flatlining here at negative 0.40. What this is really telling us, ladies and gentlemen, is that you're seeing a pretty decent flood of new homes coming on the market, and you're seeing a lot of foreclosures starting to come on the market. I think that's going to change over next year. I think you're going to see a flood of foreclosures hitting the market over the next 12 to 18 months. Next, we have the heat rank. Heat rank is strengthening a bit. You can see we had this weakness into the end of the basically October, November. Little bit of strengthening here, which is telling us again that as we're starting to see price reductions, you're going to see some houses move, particularly in the hotter areas. There are still areas of the market which are very hot. So you're going to see investors, and particularly like BlackRock and institutional investors, still trying to buy into real estate. But the tightness rank has gone very weak. Okay, this is a big change in trend. So the heat rank here has weakened down. You can see the tightness rank. This is telling us that the market changed direction. There was a big change in how the market is reacting as of October, November, December. It's the same thing we had here. Heat rank weakened. Now we've seen it kind of recover into the Christmas season. We are going to see with the new Fed rate increase, a 50 basis point rate increase. I expect this is going to roll back over, especially with the winter months, especially with Christmas and with the higher cost of borrowing. I think we're going to see this roll back over into a moderately weak trend by February, March. I think we're going to see this roll back down into negative 4, 5, 6% area on the heat rank, kind of down into this area here, and this area back over here. I now understand, ladies and gentlemen, if we get into this negative 10, 12, 15, kind of like we saw back over here, this is really a very weak market, a very weak market. So you look here, April, May, June of 2021, that puts us here, April, May, June of 2021. This was a pretty big decline right here. And this is a modeled system that I created. So this shows you that we went through, with the first Fed rate increase, we went through a very deep collapse in the market at that time. Inventory strength is strengthening back up, but you can see this downward trend. It's very clear to see if you follow a line right across these highs and across these lows. We're in a downward inventory strength area. I think we're going to roll over here very quickly. In January, February, March, you're going to see this roll over and move back down into inventory strength is going to become weaker. And this is basically a measurement of, think of it as you own a shop, you're selling widgets, you bought a bunch of widgets. Is the inventory that you have in widgets gaining in value and strength, becoming more valuable, or is it becoming less valuable? So when we move into the positive territory, it's gaining a little bit of strength here. It's becoming stronger. When it moves into negative territory, it's becoming weaker. So we had gone through a very weak period here, just like we saw over here. And now if we roll over and move back weaker, we're going to start to see a deeper decline, kind of the bottom falling out of the support falling away from the housing market, which will mean we'll see sharper and more increased price declines. Seller desperation has weakened. We need to be aware of the scenario that, you know, here, for example, in June and July, we had a fairly weak desperation period. You can see in June and July back over here, it got, you know, this was essentially a market tightness, became very tight. So you can see here, I should actually invert this because it's a better indication inverted. But you can see here that seller desperation is starting to increase a bit. This is what this is telling you. We're seeing the sellers start to become a little bit more desperate to sell their property. You can see here in June and July, we had this increase, and I want you to be aware that this is really a tightening of the market. Sellers were less desperate. Sellers were more desperate back over here. And you can see this area back over here. June, so when you see here, May, June, July of 2022, April, May, June, July, right over here, 2022, then the market tightened back up. Strength came back to the upside. June, July, heat rank. It started to heat back up. And you can see that desperation became weaker. This is a weaker desperation. You're not seeing sellers as desperate and trying to sell. What you're seeing here is this is desperation over here. And we're starting to see sellers move back into a desperate area trying to get back out of it. I will invert this to represent a higher, a more efficient seller desperation level. Okay, so heat rank is up at 1.07%, gaining a little strength. Tightness is at 9.45. That's this area right here. This is actually change week over week. Inventory strength is 1.55. It's moved a bit higher. And seller desperation, it's minus 2.5, indicates that we are seeing a strong, fairly strong seller desperation mode. So what's happening, ladies and gentlemen, is, you know, this cold, this winter, we're going to see how we transition into 2023. I do expect the Fed to want to try to move another 25 or 50 basis points with the next Fed rate increase. And I do believe this continued pressure is going to put pricing concerns very strongly in the forefront. And I think that's the next thing that we're going to look at is come back over here. I think we're going to see price trends drop back down into the minus 10, 11, 12 period and continue to weaken as the market seeks out a bottom. Price reduction activity will start to move higher. Active listings will flood into the market as people are forced to move out of the out of their comfort zones, and we'll see how this plays out. It's basically a revaluation trade. And now what's happening, it's very interesting how as the Fed moves interest rates higher, you know, bonds will become more attractive. Stock market and the US dollar obviously will become more attractive because as US bonds become more attractive, investors want to put money into US dollar-based assets, US dollar-based debt and bonds. But why will real estate become less attractive? It's very simple. We've seen a very strong push to the upside. You can see here the demand cycle has been incredible. We've seen 4 or 5 years of really incredible pricing. We are now going to be looking at an extended possible 2 or 3 years slide to a base value before we might see some more appreciation. It all depends on what the Fed does and where Fed tries to keep rates. I think the Fed is going to try to keep rates eventually at around 2.5 to 3.5% Fed funds rate through, you know, going into end of next year, maybe 2024. But right now they're trying to burst inflation, which is going to cause pricing trends to fluctuate in the housing market. And I really think we're looking at about another 20-25% decrease in house prices, given what I think is going to take place over the next 12 to say 24 months. So pay attention. We'll see how this plays out. Now I'm going to go off to the TT Scanner hot list video and try to get that ready for you. Again, have a Merry Christmas. Stay solid, protect your assets, follow my research, and get ready for my updates on my website, which should happen in early January, probably around January 10th or 15th. All right, guys, thanks a lot. Bye.